Unfortunately, this week's not going to be so easy. We've got the battle of the timeframes raging on, and in addition, we've got earnings from Amazon and Apple, the FOMC press conference from Jerome Powell, and the full labor report coming out on Friday. So let's buckle up and build a game plan to handle all of this. As always, check out the links listed down below in the description, hit the thumbs up button, and subscribe for 100K by May. We're almost there, and stick around until the end of today's show. I've got one additional trade idea to share with you that you won't want to miss. With that said, let's jump right into the charts. So kicking things off on the SPY weekly time frame chart, what do we see in terms of candle structure and location? In terms of structure last week, solid green-bodied bar with very minimal upper and lower wicks, strong close from the buyers directly at the highs of the weekly range, so I would certainly say that the bulls are in control there. If we're thinking about location on the bar-to-bar count, we do have a higher low but also a lower high, giving us a very classic inside bar. Very difficult to say that anybody has control in that instance, so a little bit more neutral on that front. 1 for 2 goes to our buyers on the weekly time frame, and one of the things I want to continuously remind you of is that the momentum over here is strong and in the upward direction. If we come in with our Fibonacci from the October low of 2023 to the all-time high, this pullback is well above the 38.2. So for the most part, I'm trying to align with this acting as a weekly higher low, but one of the concerns we've talked about on the channel here, and hence the battle of the time frames, is the idea that we've actually punctured this level right here. Remember that was going to be the first key line in the sand on the weekly, coming in from the January pullback up to the all-time high. That was also a 38.2 from this perspective, so we punctured that. Obviously, there was price acceptance underneath, which means it's technically possible for a lower high to be found here on the weekly time frame chart. So when we're talking about the battle of the time frames, one of my concerns would just be if the weekly chart cannot clear this 512.50 area, and we'll see that again on the daily time frame chart in just a moment. So I would be inclined to say if we're over here, much more confident in this holding as a weekly higher low. If we're underneath, and we'll clearly see this as a rejection point on the daily, if we're underneath, becomes a little bit more hesitant, and from here to here, that would just be a lower high. Remember that we're using this as a possible blueprint to navigate that if it takes place and if we get a rejection around that 512.50. Some of the other data points that we've been considering here for quite some time are the anchored VWAPs. We undercut the anchored VWAP, and now we certainly have a stronger close above. If we had formed a little bit more of a weekly upper wick, if this looked like an inverted hammer, maybe something more along the lines like this, closing back near that anchored VWAP, I would be much more concerned, but because of the stronger close from our buyers, I'm willing to again try to align more so with lows, higher lows, volatile pullback, yes, but still technically a higher low in the overall weekly trend count. Once again, trying to give the respect it deserves to 512.50, which we'll explore further on the daily time frame. Let's drop it on down to a volume profile here, just because this also helps reinforce that 512.50 area. It is a high volume node. If there's ever going to be a place for a weekly lower high to be set, I believe it's going to be right there. So this week on the weekly time frame chart, it's all about what happens at 512.50. On the daily time frame chart, let's firstly evaluate this week's expected move. If you're not familiar with this study, check out the video tutorial in the top right-hand corner. If we're contained by the upper bound, the number's at 516.61. That, of course, would imply a pretty major higher high on the daily trend count. If we're contained by the lower bound, the number's at 499.92, implying a very nuanced higher low. So the expected move does strike me as being slightly more bullish than bearish, simply because it offers up the opportunity to break and violate the weekly line in the sand for that possible lower high. You can clearly see this area on the daily time frame chart with multiple instances of support leading to the major breakdown, which has caused the very minor daily downtrend that we've drifted into. However, let's evaluate this trend because, again, the battle of the time frames is raging on in its entirety. In my view, this area right here, in between 512.50 and 503, is going to represent no man's land, simply because we have the opportunity and the offering of a weekly lower high up against 512.50, but the opportunity for also a daily higher low up and over 503. And let's remember why 503 is so important. Not only does it reference the NVIDIA earnings gap, not only is it the previous weekly top of the 2-bar range, not only is it the 38.2, an anchored VWAP that we were just describing on the weekly time frame chart, but you can see here on the daily time frame that this is certainly the beginnings of a trend reversal, right? We technically have lows, higher lows, and if we get another higher low, we're finally pulling back from the highest high in the trend count, right? We had highs, equal highs on that Wednesday session, and on Friday, we certainly have a higher high. So if a higher low is found here, technically the daily trend is up. We're not out of the woods from the weekly perspective because we're still underneath this possibility at 512.50, but it's a good first step. What the buyers would ideally like to see here is a break for continuation and a higher high over 512.50. Then any higher low pullbacks over 509.50 would be ideal. Also support off of the daily 50 SMA. If we can use this area as support after another higher high over the weekly line in the sand, I would say that it would become very difficult for the sellers to really enact more of an edge and break down on the weekly time frame. If the sellers are going to build an edge, obviously that would require some sort of breakdown underneath 503, a lower high underneath, and then we're basically aiming for the equal low down here at 494.25. Some of my concerns on the daily time frame chart come from the push and pull also, not just that we saw from a fundamental perspective last week. Obviously earnings sent the market all over the place. We saw a gap down on Thursday, a gap up on Friday. I think we're going to get that again this week with, of course, Amazon on Tuesday, Apple on Thursday. You get the FOMC on Wednesday, and then on Friday, it's the labor report. So from a fundamental perspective, lots of data incoming that can cause volatility. But the reason I wouldn't describe an overall edge here on the daily chart in this box is also because a lot of the supporting evidence actually continues to support a risk-off rotation, and we'll explore that in today's episode. However, if we think about the daily structure that's actually printed, it's completely contrary to that. Notice that on the gap down from Thursday, we not only closed the gap, there was no gap fill reversal, but we closed inside of the Wednesday range. So if stronger sellers were here, ideally they would have printed a lower high on the daily time frame chart and kept us underneath 503, underneath that key weekly level we were just describing as well. That simply didn't take place. And then on Friday, when we gap up, the sellers once again are not strong here. There is no gap close underneath us, and obviously we've closed on a higher high. Now, I will give some credit where credit is due. There's certainly the offering in this upper wick of a small rejection at this previous area of support, the Friday low of what is now, 3 weeks ago? So that is on the table, but it doesn't look overly concerning, especially if, once again, we consider this on the daily, the beginnings of a double bottom reversal. I mean, higher lows and bullish consolidation can be found here. Then we'll look for that upside to at least test the weekly inflection point. If we do pull back further, we just described also how 503 can act as, again, a daily higher low. So I'm a bit torn based on the evidence. The price structure itself would suggest that sellers don't really have it going on here, but the threats in terms of a risk-off rotation are still alive and well. Let's get granular now on the daily, or hourly, excuse me. The hourly time frame chart does a great job of illustrating just how complex navigating no man's land can possibly be here. If we're thinking about bullish situations, we're looking for a break over Friday's high of day, and it wouldn't be unreasonable for a pullback off of the weekly line in the sand. From there, ideally, the buyers would get some sort of higher low up and over Friday's high around 509.50, which was also the low of this previous Friday bar that we've been describing. The only issue with this, and yeah, of course it would be great to get bullish consolidation and a breakout over time, but what if we actually drop underneath 509 for something that looks like this and a lower high develops below? Now all of a sudden, this looks like a head and shoulders, and this is just setting your weekly lower high. So those are the complications to the upside, but what about the downside? If we do move in the downward direction first and there's a sharper pullback, that's fine, but remember, we're looking for a double bottom and then some sort of reversal back in the upward direction to hold 503 as a possible daily high or low. If that doesn't take place, and if we do move through this, offer a lower high underneath, then all of a sudden this also starts to look like a head and shoulders, and now we also have a weekly lower high that's well below the line in the sand that we've already identified at 512.50. Of course, there are a number of other configurations. You could do something like this early on in the week for a pullback that holds 506. In my view, this would be ideal because, of course, it represents the hold of these equal highs, previous resistance now acts as newfound support. Then we're bullish back up through the Friday high, looking for a move into what? Then rinse and repeat all of those situations we've already described at 512.50, right? So inside of this no man's land, I don't think anything is as straightforward as possibly it seems, and you really want to wait for higher confidence trades. If you're bullish, up and over 512.50. If you're bearish, underneath 503. Doesn't mean that you shouldn't be scalping inside of this no man's land. Of course, there are going to be plenty of opportunities, but higher conviction trades probably happen outside of the battle of the timeframes here. If we go ahead and throw on some anchored VWAPs on the intraday, yesterday, you can see that we've got decent confluence around this 503 zone coming from a number of different data points. We've got the Monday low, we've got the Thursday gap down low, as well as the breakdown from Monday of 2 weeks ago now. All of that would be suggestive that something like this is not totally unreasonable, acting as the daily higher low that we've really been describing. So 503 makes a lot of sense as an area of support. If we do break to the upside first and then pull back, it would also strike me that this anchored VWAP would slowly move in the upward direction. Using that as support from the top side down would also make more sense for bullish consolidation and the possible break in the upward direction over the weekly line in the sand. So from an anchored VWAP perspective, probably leaning a little bit more bullish, but again, not overstaying our welcome inside of no man's land. What about Fibonacci's? Any confluence from this point of view will come in from the low of the move up to the top of the move. The 38.2 is loosely aligned with that 503 level. So once again, if the bulls are going to maintain control, ideally some sort of daily higher low is produced up and over 503. Checks out from a Fibonacci point of view. What about from Thursday's low though, up to the Friday high? Yeah, what I wanted to see was where we landed in terms of the gap. So a gap fill reversal is also very reasonable around 504.25. At that point, we're almost splitting hairs. Again, treat this as a higher low zone. 504.25, 503 on the downside. Let's clear that up, and let's also take it from the top of the Monday breakdown from 2 weeks ago all the way down to the low. And what you'll see from this point of view is that the 38.2, which in this case would be a major line in the sand, as long as we're above that, which is aligned with 503, the odds would be decreased for an equal low down here. So if you are leaning bearish out of this market, you would really want to see the firm breakdown underneath 503, or at least a solid way to manage risk based on a weekly reversal, right? Something that looks like this. If you can spot this pattern and you're leaning bearish, by all means, right? Your risk reward makes sense if you're trading from a weekly point of view. If your risk maybe looks something like this, to sort of put a stop over the top of that move above the weekly lower high, if you're entering on some sort of breakdown, let's just say underneath this level right here, and your target is all the way back down to the equal low on the weekly chart, by all means, this checks out from a loosely 2-to-1 risk reward perspective. But once again, you need to know your time frames. This is not a day trade, right? This is not a scalp, in other words, is what we're getting at. So I think the short-term data points certainly lean a little bit more bullish, but we have to be respectful. I think this is the main point of today's video. We have to maintain respect for that 512.50 opportunity for a weekly lower high. Supporting evidence exhibit A is always the market internals. If you're not familiar with this screen, check out the video tutorial in the top right-hand corner. This is really going to dial back some of the bullish sentiment that we've expressed so far. And to do so, let's just compare the Thursday and Friday sessions to the Monday and Tuesday sessions back here. Thursday was a pretty impressive rally to close the gap and even close inside of the Wednesday range. Now, what did we get from a volume perspective? Not very much in terms of inflows. On Friday, when we printed that higher high, I mean, yeah, we saw inflows, but they're nowhere near substantial, up around 300 million. Compare that to Monday and Tuesday, which look much stronger in my opinion. We could do the same thing out of the advanced decline line, and even the index score is really the most important part down here at the bottom. Notice that on Thursday, I mean, we do get a positive build out of the index score, which is a decent first step, but is it anywhere as positive as what we saw out of Tuesday or even into the end of the session on Monday? The answer is just absolutely not. What about on Friday, when we're making that higher high on the daily time frame chart? Again, not even close in terms of as strong as what we saw on Tuesday or Monday. If we think about the cumulative build out of the tick, pretty solid, pretty solid. Here is our big counter trend rebound day on Thursday from the gap down. Basically no participation at the exchange level. Very, very sporadic there. And on Friday, again, undeniably positive, but nowhere near the same strength as what we saw on Tuesday or even Monday. So this alone is not enough to say, oh my goodness, it's a big new money short now, setting up the big weekly lower high. I wouldn't go that far, but I would be a little bit skeptical and dial back once again some of the bullish enthusiasm that we've suggested so far. Market profile is always exhibit B. If you're not familiar with this screen, check out the video tutorial in the top right-hand corner. Let's keep it simple to begin with because the value area and point of control from Wednesday, Thursday, and Friday really tells the bulk of the story, in my opinion. If we think about Thursday, you can clearly see that value area was not even close to becoming overlapping to up with the Wednesday session. Even though we closed inside, value was found lower in that individual profile, and you can also see that the point of control is technically underneath this F period single print, which means that was a double distribution, and value was found in the lower portion of that distribution. That's technically progress for our bears. So in theory, it wouldn't have been unreasonable if on Friday we we opened in range, price was drawn towards that value area and point of control and moved in the downward direction. It simply didn't take place. Obviously, we gapped up, and notice where value area is here. Based on the P-shaped profile from that Friday session, I think that this sort of aligns with the idea that we do not necessarily have stronger buyers entering the market, and this is a little bit of a short squeeze on Friday, which also helps explain some of the weakness in the market internals that we were just exploring, right? So anyone who is positioned short down here from the gap down on Thursday squeezes out, forming the post of the P in the A period single prints, and then value is found higher. Now, one of the push and pull points, because technically short squeeze and not necessarily new money buyers, that would be a bearish data point, right? However, counterbalance that with the fact that the value area and point of control on Friday is technically over the entire high of that Wednesday session. So push and pull continues here, even on the market profile charts. I would encourage you to be thinking about Wednesday's high as a possible breakdown point to close the gap underneath us and start looking for that double bottom we've described on the SPY hourly time frame chart. You can clearly see that there's not much volume commitment at price here, and if we break down underneath loosely half back, that level is around 51.25 in the ES futures. That's where the breakdown could originate from if we're just consolidating inside of the range and see a leg lower first. I would also point out that we do technically have a poor high here on the Friday session. If it needs repair, we're looking for a break, and the next major upside target out of the ES futures is loosely 5,200. Let's change gears now over to the QQQs on a weekly time frame chart. We're going to see a lot of the same over here. However, we'll kick it off as we always do with candle structure and location. In terms of structure, solid green-bodied bar with a strong close from the buyers near the highs of the weekly range bulls on parade from that front. If we're thinking about location on the bar-to-bar count, higher low as well as a lower high, classic inside bar, just like the S&P 500, a little bit more neutral on question number 2. If we're thinking about the context of the overall weekly trend, though, the higher low is a bit more respectful of structure here on the NASDAQ 100. Don't get me wrong, it was a violent pullback as it was actually taking place, but take a look at this, right? You are getting support here for a possible higher low off of a previous area of resistance, and as we know, if we bring out a Fibonacci from the October low of 2023 up to the all-time high, we are still technically above the 38.2. If we go ahead and bring out some anchored VWAPs here on the weekly time frame chart, we did support over the anchored VWAP from the October low as well. And of course, the concession that we need to make now is that the overhead supply 7-week balance range can certainly offer a lower high. This anchored VWAP from the January pullback can also offer a lower high. So the battle of the time frames rages on here in the QQQ NASDAQ as well. This number right here, the bottom of that overhead supply, is 433.75, and we'll take a closer look on the daily chart in just a second. But before we go there, let's bring up the volume profile on the weekly just to reaffirm that this is also making sense as a high volume node, just like the S&P 500. On the daily time frame chart, we'll begin as always with this week's expected move. The upper bound is at 440.67, implying a higher high, and also a suggestion that it's possible to break out up and over the weekly line in the sand, which is clearly illustrated here on the daily time frame chart. All of these previous interactions as support now have the clear opportunity to act as resistance for a weekly lower high that we were just describing. Once again, the expected move would suggest no, it's the opportunity to break out up and over that, right? In terms of the lower bound, the number's at 421.38, and just like the S&Ps, a very nuanced higher low being offered here. If we think about the no man's land equivalent out of the QQQs, the zone I would really use is right here. It's not technically down towards this 421 level. I would really use the gap fill reversal off of the Friday gap up at 425.25 as your major line in the sand. If this is going to start to act as a double bottom reversal on the daily, you probably don't want to go much lower than this area here. And even just noting that, yes, that would be a pullback from the highest high, you don't want to have the threat of a possible lower high underneath. So 425.25, if you do spot the lower high underneath, that's where I would say, okay, this makes a lot more sense as a possible weekly lower high. If we're supporting over the level on the daily time frame chart in here, I would maintain a little bit more of a constructive outlook, saying, okay, what's the opportunity to at least test and see what the reaction is off of 433.75? Any higher lows above that obviously are much more bullish for our market, and there is technically a thin structural retracement that can happen in here for the retest of 437 on the upswing. So daily time frame chart is trying to be constructive in the upward direction, and once again, your no man's land is in between 433.75 and 425.25. Let's take a look at the hourly time frame chart to get into some more nuanced pathing out of the QQQ. Very similar to our S&Ps, where we can come in here with a number of different crayons. If the bears are going to make something happen, it's got to be this. lower high underneath 425.25, and this starts to emerge as a very classic head and shoulders. Looks like a weekly lower high. Things really deteriorate underneath 421 for an equal low on the weekly chart around 415. So that's bearish setup number one. Bearish setup number two could be a look above and fail on the weekly level. This is something that I would certainly carry forward more so on the QQQ compared to the S&P 500. Something that looks above here and finds a lower high underneath, right? This sets up, once again, there is your head and shoulders. That's looking like a weekly lower high, rejecting the overhead supply that we were just exploring. If the buyers are really going to make something happen here, show me the continued consolidation in this zone. Show me the break. Show me the higher low above, not just a break above. Show me the higher low above 433.75. Once again, there's your thin structure retracement for at least a rotation into 437. Anything beyond that will take in stride. Once again, we're expecting a volatile week. We have a number of earnings announcements that will be highly influential for the NASDAQ as a whole. If we do see a pullback first, the buyers would ideally like to see, let's clear that up, here we go, some sort of gap fill reversal. If it emerges as a higher low double bottom, that would be fantastic as well. If it really just offers something that looks like this, that also makes sense. And once again, holding this zone really right here, holding this gap fill reversal over 425.25, it keeps us in no man's land, but at least the risk reward makes sense for a full test of the weekly overhead supply, right? The idea would be risk reward wise, if you can risk something like this to capture maybe 2x on the upside, or at least try to traverse that range, that makes sense from that risk perspective. Let's go ahead and throw on our intraday anchored view apps and see what's going on from this point of view. Lots of confluence around a lot of these key zones, as we've described, very similar to the S&Ps, 425.25 being reinforced based on the anchored view apps, and you can see that any consolidation up here looks good early on in the week. That would keep us over the anchored view app from, of course, this large breakdown. It's the first initial one when we had those geopolitical tensions, if you will. So staying here and looking for something like this, not unreasonable. Something that does this, also not unreasonable. Have to be mindful of the threat though, and we need to respect 433.75 as a possible weekly lower high. Let's bring out the Fibonacci's to sort of finish up our NASDAQ hourly, then we'll take a look at the internals. 38.2 is dead on the money at 425.25, so all good. Bullish, healthy consolidation in the grand scheme here if we're measuring from point A to point B and trying to get more so on board with a daily trend reversal. Let's come in from the top of the Monday move from 2 weeks ago down to the low, and what do we see out of this? 38.2, once again, right on the money, or at least close to that 425.25. So in theory, if the bears want to make something happen here, it's really got to emerge from a lower high back down underneath 425.25, or spot the higher what would you say, spot the lower high and the entry point that's higher in terms of overall price. Your risk reward might be a little bit better if you're trying to traverse this as a weekly range. But just like we described in the S&P 500, this is not a scalp, this is not a day trade, this is a weekly sort of multi-day swing trade that has the opportunity to unfold if you're aiming for the weekly lower high. Let's clear that up and take a look at the market internals out of the NASDAQ. It's almost the same exact commentary as the S&Ps. Not very strong volume inflows as we're getting that rebound on Thursday and Friday. Same thing over here out of the advanced decline line and the cumulative tick as well. Negative on Thursday, very small build on Friday, not nearly as strong as what we saw on Tuesday or even the Monday session over here. And finishing it up with the market profile for the NQ futures. Again, rinse and repeat the same analysis from the S&P 500. Here is the Thursday value area, and here is the Friday value area. Notice it in relationship to the high of that Wednesday session. Notice this in terms of the relationship to the low of the Wednesday session. Same commentary, same P-shaped profile, same idea about short squeeze, same idea that an early breakdown could come from a lower high underneath. 17,825 is the number that we've been using. It's basically this area right here. If we get a lower high intraday early on like the Monday session, lower high there could kick off a pullback to close the gap in the first place. But as of right now, the value sort of suggesting acceptance over Wednesday's high would not be overly bearish until proven otherwise. We do also have lack of material excess on the upside. And lastly, for the broad market, IWM Russell 2000 small caps on a weekly time frame chart. What do we see in terms of candle structure and location? Identical to the S&Ps and the NASDAQ. Solid green-bodied bar as an inside bar. So bullish in terms of structure, a bit more neutral in terms of location on the bar-to-bar count. In terms of overall location, the obvious concern that we've been voicing for a number of weeks now is simply the failure back down inside of the multi-year weekly balance range. And the threat, of course, is that this turns into a head and shoulders. A rejection of 199-200 as a zone is certainly dangerous, and and the breakdown of some sort of neckline in here opens the door for a firmer failure. Technically, the bottom end of the range is the target. Now, a little bit aggressive, and you'd probably have to see some more deterioration in the fundamental data there, but it's one possible concern. Obviously, the flip side of this coin is if the market does break out of small caps and finds acceptance over 200, that would certainly be helpful for small caps continuing to act as a tailwind for the S&P 500 and speaking to the broadening nature of the market rally. A couple of concerns I have if we take a look at the XRT retail sector for the S&P as sort of a proxy or at least assisting component. It's offering a very similar data point, the opportunity for a lower high underneath 73.25. So keeping that in mind, XBI is a little bit more dangerous. You can see the more firm failure underneath this 94 level. And you could even take a look at the KRE, smaller regional banks, right? Really not getting in gear, rejecting this area in here. You can see that we are underneath the neckline of what could have been a major weekly double bottom. If we reject here and continue this rotation in the downward direction, really don't think it spells helpful activity for your Russell 2000 and the small caps overall. A couple of saving graces to just give us maybe a more balanced perspective for small caps here is simply that the pullback is holding the weekly 200 SMA as well as the 38.2. So again, this is the primary concern, is that we stay underneath 200. But if we do break back up and over 200, 199 as a zone, then great. Technically, we're coming from a decent spot, a spot of strength on the weekly. If we fail this, again, it sort of cuts both ways. The failure of that key level not only triggers the head and shoulders neckline, but it's just a loss of an ideal place for a possible weekly higher low to be found. So line in the sand out of the weekly chart, your no man's land is really between 200 and loosely this 193, we'll call it for round numbers sake. Let's take that off and quickly have a glance at our anchored view apps on the weekly. These are clustered up underneath us. So once again, supportive of the idea that if we hold this and recapture 200, so there's two parts to that equation, right? We continue to hold and we recapture 200, then great. We'll be a little bit more bullish for, again, the broadening nature of the market rally, especially over in the S&P 500. If we fail 200 and fail the cluster here, then obviously that spells danger. As of right now, I have some concerns based on, again, retail, biotech, and the KRE regional banks that we were just sort of exploring as well. Let's quickly take a look at the volume profile out of the IWM. And one of the reasons why, again, this is concerning is because there's a high volume node at this zone. Any rejections of that make a lot of sense to keep traders as overhead supply here. And if we even zoom out further on this chart, right, all of this is overhead supply. We are not getting much price acceptance up and over this area of resistance, right? So the breakdown is at a logical place. And again, the battle of the time frames rages on, even in small caps. On the daily time frame chart, we can see that the weekly expected move is suggesting 203.27 as a possible higher high if contained, and on the downside, we have 193.50 offering a possible weekly higher low. It's equal lows to what we experienced last week, though. Same thing compared to the other two indexes. It is a suggestion of a recapture of the weekly line in the sand, but I'm not yet convinced all the way. If we're thinking about no man's land out of IWM and small caps, it's really going to exist in this zone right here. If we're underneath the weekly line in the sand, it's very difficult to say that the buyers have an overwhelming edge. And just as a reminder here on the daily time frame, you can see that this was also the neckline of the double bottom as well as the neckline of the double top. So this has a lot of price history around it as a major inflection point. To have more confidence on the daily time frame chart, I would want to see a break, recapture with the higher low, and then look for longs in the upward direction. To achieve that, I'd be open-minded to this acting as bullish consolidation, but I wouldn't jump the gun on any possible breaks. The reason that 196.50 is a key inflection point, zooming in on the daily, is simply noting that the IWM small caps were the only index to actually set a counter trend rally on the hourly chart and offer a daily lower high 2 weeks ago. So breaking out over that on the Tuesday session was meaningful. This offers the first higher high, and if we can stay above it, look at the inflection on not only Monday, but Wednesday, Thursday, and Friday as well. If we're over it, again, open-minded to bullish consolidation, however, would want to see the break and higher low retest above the weekly line in the sand before making any bold claims about bullish sort of improvements for the broad market as a whole and the broadening nature of the market rally. One of the things that you do need to be mindful of is the possible look above and fail here. Again, the whole reason why we're explicitly stating you need the higher low above is because if you fail back down underneath and then lower high here, you start to build out, again, maybe just for lack of a better term, head and shoulders, a breakdown of this neckline. You're trading back down into the equal lows. And what's the threat at the equal lows here? We just described it on the weekly chart. It's a failure of the anchored view app band. It's a possible failure of of the Fibonacci 38.2, it keeps us inside of the overall multi-year weekly balance range. So a look above and fail here really expedites a look above and fail on the weekly chart as well. So understand that sort of, again, battle of the time frames, which is sort of the theme of today's episode. Here we go on the hourly time frame chart. A lot of the same, not much to really explore here further in terms of key levels. We know that this, again, is healthy consolidation for all of the reasons that we can sort of see directly unfolding on the chart there. Breaks higher lows above are constructive. If it's underneath to begin, great, just show me the lower high and we'll be aiming for the equal low anyways. Let's see what we're getting in terms of confluence on small caps out of the intraday anchored VWAPs. This makes a lot of sense to me to possibly break this. And then like in my view, the one situation that you really want to be attentive to early on in the week is this break strong? I think the break is likely to happen. Not only are we pressed into this anchored VWAP, not only are we pressed into, again, you could even think of this as a daily double bottom if you can get over that neckline, that's constructive, but it's more than that. We just talked about it on the daily chart, right? I really want to make this the main point out of IWM is that you need to offer the higher low above. Otherwise, we haven't really made much progress here. If we bring out the Fibonacci's before we take it on out to the market profile, which is really one of the major reasons why I think that this level needs some repair. It's hint, hint, poor highs, but the 38.2 is at this 196.50. So again, supportive of the idea that this is still technically healthy consolidation off of the lows and maintaining a little bit more of a bullish edge. Again, I know I sound like a broken record, but please, if you're trying to look more bullish for the S&Ps, wait for the higher low over the zone. I think I've been very, very clear about that in today's episode. We can quickly come in from the Monday session of 2 weeks ago and see where that 38.2 is. And this is kind of like all over the place. I wouldn't look at this Fibonacci as a main inflection point. I mean, the 38.2 is loosely in here. 61.8 is loosely in here. Not in love with any confluence from that particular point of view. Here we go with the internals for the Russell. You can see a lot of the same on the rally points, some weakness on Thursday, Friday. Same thing here. A lot of rinse and repeat from what we've already described on the S&Ps and the NASDAQ. But over here on the market profile is where things are slightly different. I mean, look at the poor highs on this session, and this session. So basically on Tuesday, Wednesday, and Friday, incredibly poor highs. And, in theory, this is the improper end of the auction. So as the market comes up and it's butting its head up against that weekly inflection point, I think it's asking for a test, aka clear this level, and then we'll see, whether or not that higher low emerges above or if we break down and lower high back underneath. So in my view, repairing these poor highs is a top of mind priority early on in the week. If we can, it then becomes all about, do we set the higher lows above or is it just a look above and fail? And if we do fail, we all know the name of the game. That is certainly not helpful for your S&P 500. Let's start to explore some supporting evidence, beginning with the weekly performance of the S&P sectors. Leading the pack here is the SMH Semiconductor ETF, which totally is not an S&P sector, but massively influential to the market. You'll notice it's up over 8%, but let's also not lose sight of the fact that just last week it was down over 10%. So in my view, and the structural chart would agree, this is a counter trend move in the context of a developing downtrend. Just underneath is consumer discretionary, up 3.4%, and the XLK, the heaviest weight risk on style sector technology, is up 3%. So at first glance, it might appear as though this is a healthier risk on style rotation. And don't get me wrong, it is helpful seeing these sectors participate off of the lows, but the structural charts tell a completely different story. The bottom end of the barrel, the underperformer, is the XLC Communications, only up 11 basis points. And then we see the XLV healthcare sector, which is noteworthy because it's the third heaviest weighted sector by market cap. It's only up 42 basis points. The XLF financial sector, second heaviest weighted sector by market cap, only up 54 basis points, sort of raises some questions when the S&P itself is up over 2% on the week. Let's jump into that structure though now and start to tell a little bit more of the story with a fuller picture. So in the SMH, we've got to give some credit where credit is due. In the Wednesday update video, we made mention that this low at 212 had the opportunity to offer a lower high based on a weekly double top neckline and the failed gap up on Wednesday. Clearly on Friday, we've closed above it. So again, credit where credit is due. It's a solid move from the buyers. It's also a strong close on Friday. Make note of that based on what we'll explore in just a moment out of the XLY and XLK. But is there not still the offering of a lower high here at 219.70, right? If we're counting weekly trend, we have highs, lower highs. This certainly could be a weekly lower high. So the concession that needs to be made is that this is possibly neutral consolidation, and it would be bulls on parade if we can break and get a higher low over 219.70. If we get a lower high back down underneath 212, I think you can kiss this goodbye, and obviously that's your threat for the S&P 500. So again, remember the stronger close here And then let's take a look at the XLY. So in terms of an apples to apples comparison, I mean, it's nowhere even close to the neckline of its double top in terms of recapturing it. And notice the weaker close on Friday. So this to me is even more of a threat for your S&P 500. Similar comment over here out of the XLK. You can clearly see that we were not close to the retest of the breakdown point at 203.90. Instead, we did respect this more nuanced structure at 201.40. And again, the bearish inverted hammer, the larger upper wick compared to the SMH, which had a stronger close on the Friday session. So if we're thinking about whether or not this is truly a risk-on rotation, the offerings of lower highs still has me a little bit skeptical. You would really want to see some massive outperformance based on consolidation here and a recapture over 203.90 if you're going to say bullish things about the XLK in terms of trend improvement. Let's move along to energy. Not much of a concern. Maybe inflationary if we make a new pivot high, and maybe downward pressure for the markets if we fail the monthly breakout zone at 94.25 based on Friday's close. Not really partial in either direction. XLP, let's have a little bit of a discussion here. Noting that this, of course, is a lighter weight, D for defensive risk-off style sector. It's trading up towards these equal highs. Obviously, it did not offer the lower high on the backtest of this range. It did not offer the lower high on the backtest of this range. So, if we're thinking about a risk-off rotation, any consolidation up here builds out a pie-in-the-sky inverted head and shoulders, or simply call it a bull flag. If this breaks in the upward direction, don't get me wrong, yes, it's slightly bullish pressure for the S&P, but it's totally indicative of a risk-off rotation, which overall is not healthy for the S&P 500 if we're trying to spot a stronger bottom, right? So the XLP is a concern. The XLI, not much of a concern. I think it would be helpful this week if we can get a break up and over these equal highs over 122.75 and sustain it with a higher low. Any lower high back down underneath, it feels a little bit more like the risk out of the IWM small caps. Let's take a look at materials. Again, an extremely lightweight sector, not much to comment on over here. Maybe the opportunity of a reversal, but still a strong hold for a possible weekly lower high. So overall, not really a top watch there. I'd say that the XLK SMH certainly more so of a watch. Here's the real estate sector. Again, same thing, offering of a lower high lightweight sector, not going to make or break the S&Ps. XLU, again, let's have the small discussion about a risk-off rotation, right? The XLU is a lighter weight and D for defensive sector, and obviously it's looking pretty good in terms of the trend, right? New higher highs on Thursday, pulling back slightly on Friday, still the offering of a higher low over 65.70. Once again, when we're thinking about the market in terms of risk appetite and what the sectors are sort of suggesting to us, this is a risk-off rotation. This is concerning, to be quite frank with you, for the S&P, sustaining a more healthy move in the upward direction. Financials, here we go, right? Again, thinking about possibilities of lower highs up against it on the earlier stages of the week, Monday, Tuesday, Wednesday, pressuring that 41.20. Look at the fade off of it. We did technically get a mostly inside bar on Friday, so I'd be open-minded to, if the market is going to recover more impressively, you've got to show me this. So XLF is a top watch, along with the SMH, along with the XLK. I would sort of omit many of the other sectors and say that this 41.20 is like top dog when it comes to sector watches. Here's the XLV. What's going on over here? Obviously, a lot of relative weakness. It's well underneath its overhead supply. This could be a lower high. We're looking for the equal lows. This is the improper end of the auction. I would not be surprised in the slightest if the XLV breaks down underneath 138.25 this week to repair that level. Here's the XLC Communications. What's going on over here with the wacky price action? Here's Meta, here's Google, right? And we're right back at this $80 inflection point. You can clearly see a shelf of previous resistance. Ideally, this would get a rotation for consolidation here, and if buyers are really going to make something happen, show me the higher low, improve the trend over 81.20. As of right now, it's just not all the way there. So big takeaways out of the sectors is primarily that it looks like a risk-off rotation. Here is the ratio grid. If you're not familiar with this screen, check out the video tutorial in the top right-hand corner. This is an issue, right? We're underneath a now clearly downward sloping 50 SMA. This was a lower high. If you look at financials, it's right at the inflection point. It basically needs to turn right around on Monday and Tuesday and rebound in the upward direction. Otherwise, we're a bit more neutral. And then what else do we have? This is not a tailwind for the S&P. This would be neutralizing. This, of course, is a headwind well underneath a downward sloping 50 SMA. It's been that way for a while. Risk-on sectors don't really look great here. If we look at the risk-off sectors, you'll notice strong opportunities for higher lows, right? We've broken to higher highs. The trends are flipping in the upward direction here. again, speaking to a risk-off rotation, I think the ratios are certainly in alignment with that. Here's the XLK over the SHY. So again, offering of a lower high is a risk-off rotation indication. Same sort of complication over here. The lower high underneath is a risk-off indication. And let's take a look at apples to apples, XLY, XLP. There's your consolidation, clearly the breakdown, clearly the offering of a lower high. All of the sector sort of ratios we've looked at so far are bearish in terms of a risk-off style move. I know I sound like a broken record, but oh my goodness, here we go. This is the positive one, and obviously the only reason that this is taking place is because the SMH is over 8% on the week in the upward direction. So a little bit of a recapture here. If you are trying to be bullish and spot the turn back in the upward direction for a stronger trend recovery, this could be a good first step, right? If we are able to make some sort of equal high up here and the market's still lagging, and then some of those other ratios start to improve as well, the equal high should, in theory, be met with an equal high out of the index underneath, and obviously that's not really in force yet out of the index below. So watching this, ideally you would get a higher low over this 1.5 area over the 50 SMA. And once again, this ratio is semiconductors compared to the XLV healthcare sector. Let's move along to the dollar, because the dollar is also a bit perplexing here this week. Notice on Friday, it was sharply higher off of this area of support, coming as the top end of the long-standing balance range. So continuing to consolidate over that, in my mind, continues to put bearish pressure on the S&Ps. So the S&P was gap and go on Friday along with a higher dollar. Something's not totally adding up here, and in my view, with the FOMC, this is ripe for volatility and really an expansion of volatility. So you may think things have settled down. Not really. I'm not getting that sort of feeling based on what the dollar and the market did in tandem on the Friday session. If we look at gold, it's continuing to drift in the downward direction for a mild pullback. You can spot a lower high in here, but once again, I mean, anything on the weekly time frame chart is a massive high or low for the huge breakout we've been tracking for quite some time now. No surprises over there. The TNX interest rates, again, will be volatile this week if they can get some acceptance up and over 4.68. I mean, 5% is right around the corner. And I think that the right combination of words from Powell can easily get us there. If we take a look at the inverted ZT to get a sense for what the 2-year is doing, right? If this breaks out, and again, Jerome Powell just has to say the right combination of words, and we're right back up at these highs, that, of course, has to be downward pressure for the markets, or at least I would imagine it to be such. So let's take a look at the tracker tool now and get some more insights. So there are actually 0 insights to glean from the Fed tracker tool, still noting that we are higher for longer directly into the September timeframe meeting. But I would watch for these odds to shift dramatically as we approach and navigate this week. And the first reason for that is if we take a look at the data we got last week, I mean, GDP first and foremost, massive miss here, 1.6 versus a 2.5 expectation. Everybody's been touting, and myself included, based on the data we had received prior, that we were experiencing above trend growth in the economy, and that's simply not the case anymore. So although the Fed does not have a mandate around economic production and GDP itself as a metric, I would sort of say you might be a little ignorant to not believe that Jerome Powell is at least considering what's going on here. It's almost the perfect storm that's going to work against him, right? As economic contraction is possibly taking place and inflation is possibly reaccelerating, and we have to stay higher for longer, his only saving grace is that the labor market continues to remain fairly robust here. The initial jobless claims on Thursday coming in at 207,000 versus the 214,000 expectation is kind of a decent sort of back pocket idea for him. If we take a look at this week, right, we're going to get the ADP non-farm, that's fine. The JOLTS job openings on Wednesday, that's fine. But here's where things really heat up on Friday with hourly earnings, the true non-farm payroll, and the unemployment rate. I'm not really expecting much of a change here, considering that as we track every single week, the initial jobless claims, they've all been very well under control. So really the biggest deal would be if the market is not, the job market, is not continuing to add jobs, that would be a little bit more of a concern and something to monitor. And again, here is your press conference from Powell on Wednesday at 2:30. Look for those odds to really jump around here out of the Fed tracker tool. If we look at GDP going forward, the Atlanta Fed released their first estimate, and notice this is just shy of 4% after a huge miss at 1.6. So is someone out back cooking the books a little bit, throwing in a little bit of salt and pepper where they shouldn't be? I wouldn't go out on a limb and make that direct claim, but it seems a little bit odd that we would all of a sudden rebound right back to 4%. So watching out for that out of the GDP tracker. If we take a look at PCE, this came out on Friday, as we know, you'll notice that services still continues to be the massive contribution to inflation, whereas everything else, durable goods notably, are deflating here. You'll notice that nonprofits are sort of, within bounds of normal reads. We really want services to be back in line with something like this. So about half of what we're currently experiencing out of services inflation. So higher for longer out of interest rates is really the only way to make that happen. And again, we've talked about the threat with GDP starting to contract. The whole reason that all of this is important is because it really boils down to the takeaways for earnings, right? And earnings are at the end of the day what really drive the markets over the long run. Now, we're looking at forward guidance, be it positive or negative, for Q2 based on companies that have reported Q1. And if we look at the infotech sector, the idea is not to say that we have more negative guidance, but rather a balance of guidance. We've got sort of uncertainty. Typically, people guide forward positively, so people are like, great, the company is growing, right? And then it's an issue when they miss and come in underneath the guidance, and that's a whole different thing. That's managing expectations. But as we're understanding that Jerome Powell is put between a rock and a hard place as of right now, with holding rates higher for longer, that's being reflected in Q2 guidance. If we take a look at 2024 as a full year, you can also see the same thing. I mean, in industrials, you're getting mixed bag. Out of infotech, you're actually seeing more negative guidance here. So again, in terms of managing expectations, is it going to be awesome when they come out and say, hey, remember that guidance we said way back when, we actually blew it out of the water, this is great, send the stock higher, right? That's a possibility, but just taking this at face value, I think it's a small concern as we continue to navigate, once again, higher for longer from the Fed. If we take a look at profit here, this is profit margins, Q1 2024 versus Q4 of 2023. One of the things I want to point out is that revenues are actually increasing, so you're seeing numbers go up, but profit margins are actually down out of tech. And the whole reasoning that this is relevant is because the way that happens is that their borrowing cost is obviously much higher, right? Financing costs are much higher. Whereas financials, they actually relish in higher rates because they're the ones originating loans in the first place, right? They charge higher fees. They're the ones eating into the margin of the infotech sector. So remembering that infotech is basically the heaviest weight driver of the S&Ps, thought that was noteworthy to point out here. We're still sort of about midway through earnings, and we have a lot of things to continue to unfold here. But so far, the market pullback has coincided, obviously, with a bit of a PE correction, which is the whole premise of higher for longer in the first place. So is the market reacting appropriately to the data? I would seemingly answer that question with a resounding yes. If we look at the earnings calendar for this week, notable mentions here, Amazon, obviously, super micro, everybody's going to be freaking out about. AMD, of course, is in there as well. I would say that Starbucks is maybe interesting. You get some consumer staples names out of here. Qualcomm on the Wednesday after the close, and then you can't ignore the old guard, if you will, up here at Apple. Thursday after the close, we'll see how it comes out. But with that said, let's take a look at risk appetite. So the TLT ratio to the S&P is currently not suggesting any flight to safety style trade, which in theory would be supportive of a bullish market down below. However, I think that this is a little bit deceiving. As we know, equities are a longer dated risk asset. So if we look at bonds in relationship to themselves, we can actually learn something about duration, right? As we take a look here, the uptrend is intact, uptrend is intact, uptrend is intact. We're sitting on the higher high, we're sitting on the higher high, sitting on the higher high. And this is just an illustration that the preference is for the shorter end in terms of duration. So is it true that there's solid risk appetite for equities down below? Bonds would not have me totally convinced. One of the more bullish data points, though, is if we take a look at credit spreads, they're actually moving in the downward direction, most notably out of the shorter duration here, offering a lower high. And if we can just get tangled up in this area, if we can actually print a lower low this week and actually drift into a downtrend, that would support more so a stronger recovery out of these lows. We'll keep an eye on it. We're not all the way there yet, but it's right on the cusp there out of credit spreads. What about the HYG in isolation? Because there is a divergence happening here. Notice into the end of the week, the lower high versus the higher high out of equities. So sort of walking it back in terms of the bullish stance out of credit spreads, as long as this is rejecting out of the HYG high yield junk, basically, I don't really see a world in which it would make sense for equities to aggressively be trending back up towards these all-time highs. So watching this as a bearish data point this week. If we take a brief glance glance at Bitcoin, it's really not doing much, still stable inside of its bullish consolidation range. Let's move on into some market breadth indications, and we'll take this actually down to a daily time frame chart. We need more than 3 months. Wrong click. There we go. The reason I want to show you this is that we've talked about the fake recapture over here when we were topping out in August of 2023, and we made note that, hey, it's fine if we go positive, but if we go negative again, that's really a concern for the market. One of the differences that's taking place here is actually the higher low on the daily time frame chart over the zero line versus here, it was just immediately back underneath and then a lower high. So I'm not saying that the lower high can't happen, but this is a good first step instead of some sort of move to immediately get negative in the first place. Let's take a look at the SPX A200R, pretty stable up near its 70% mark. Small move in the upward direction this week. SPX A50R is still the larger concern underneath 50%. If this just rejects here and stays below 50%, again, there's your August high, sort of mirroring that sort of breakdown, right? When and if this were to get massively oversold, this is ideally where a stronger counter trend argument could be made from. Let's take a look at the RSP in terms of the equal weight S&P 500. One of the comments over here is just the perfect hold, basically, of this previous structure. But what's the threat, right? Is there not the opportunity for a lower high here? Right? Absolutely there is. And in terms of no man's land, any lower highs underneath that keep us there. Weekly lower high, possibly, respecting this as a monthly, weekly high or low, it gets a little bit tricky. So in here, out of the RSP, not really clean. Ideally, buyers would want to get up and over 163.63, or sellers would want to get underneath 158.50. Watching that this week. As of right now, this formation into the level, it is a little bit cup and handle-esque, so we'll be giving the buyers the benefit of the doubt to see if we can get some sort of bullish break up and over that number. If we take a look at the QQQE, equal weight NASDAQ 100, one of the big comments over here is that the weighted NASDAQ down below has come in for a retest of the level versus the equal weight up above, very, very far away from that level. What would this speak to? Obviously, it's the massive strength out of Microsoft and Google that really sent the market higher out of the weighted and not fully being felt. Its effects are not fully being felt. The bullish nature is not fully being felt across the entire index as a whole when everything is weighted equally, right? Let's move along to the Dow Jones and see what's going on over here. Looking for a breakdown through the 37,777, too many sevens. Looking for a breakdown there based on the lower high out of transports and the threat of a bear flag. This, of course, would be bearish drag for the broad market as a whole. Talking about volatility now, what a great spot to find some support. Previous resistance acted as support. Is it possible that we could see 15 act as support, a new floor here? I think the answer is absolutely yes. If we dissect it a little bit further to the VVIX, the comments over here is that, remember, when the August high was put in, right, we did see a substantial contraction in volatility. Here's your break of the 103 level. There's your substantial contraction right back towards this sort of zone. Basically, the illustration that we're getting at is keep an open mind. Just because we're underneath 103 does not mean that we're out of the woods. It doesn't mean that we're going to get some sort of miraculous equal high on the weekly and things are going to be fine and dandy and a new all-time high is going to be made. Would it be great if that happens? Absolutely. Of course, I have long positions in the market, like in terms of investment accounts. I'd love to see a new all-time high, just like anybody else would. However, we're trying to keep our wits about us and manage all of the data points. This is just a great example of how you're not all the way out of the woods just yet. If we take a look at volatility futures to check for backwardation, we're still all set here, moving into a deeper contango, which is positive now over the zero line. All good there. You can see the same thing here, getting over the zero line, and the one-day VIX actually broke down on Friday. I'm not convinced, though. I would want to see some prints down here at 745 to say that volatility is a non-issue, considering that we have earnings, we have the Fed, we have the labor market report. I'm not of the belief that volatility is magically going to become a non-issue. I think that the market continues to be fairly difficult to navigate until not only time-wise we're through some of these data points, but also once we can resolve those larger weekly zones we were just describing in the S&P 500. If you've made it to this point in today's show, I'm sure you're enjoying the analysis. Do me a favor and hit the subscribe button for 100K by May. We're about 15,000 short, and we've got 3 days to do it, so let's see if we can make it happen. Otherwise, we'll just kick the can down the road. In terms of Apple, up first on the core list of companies on the chopping block today, it's going to be fairly straightforward. We do have earnings, or at least Swiss cheese, to deal with from earnings on a lot of the core lists. So on Thursday after the close, Apple releases earnings. That means I would be willing to trade it on Monday, Tuesday, maybe Wednesday early in the morning session, probably not on Thursday whatsoever. whatsoever. The daily time frame trend is certainly in the downward direction on Friday. We printed a bearish inverted hammer, looking above these two equal highs, failing and closing weak on the lows, looking for a move in the downward direction to at least navigate towards these equal lows at 165.25. If we take a look at the hourly time frame chart, how do we actually pull off this trade? Well, this wants to turn into a head and shoulders, break 169, spot the lower high underneath, and look for the thin structure retracement into the breakout point at 167. That's your first target, and then we'll see if we can get continuation into the equal low that we just described at 165.25. If the buyers are going to make something happen, if there's going to be a miraculous turnaround story out of Apple, then fine. Show me the consolidation here. Show me the thin structure retracement after the higher low up and over 170.50. That's his prior pivot high. Thin structure to retrace back here, and the target is 173.75. For now, because of Apple's prevailing winds in the downward direction, I'd be more biased in the downward direction, especially noting the failure on that Friday upper wick. If we move along to Microsoft, solid move higher on earnings, fading off a little bit here. I would just be mindful of the 400 gap close. The idea out of Microsoft is that even if we can go for a gap fill reversal, that keeps us inside of the overall distribution, and this was nothing more than a fake out based on the meta sympathy move on Thursday. So 400 is a key line in the sand. If there is going to be a stronger break in the upward direction, clear the daily 50 SMA, put in consolidation up here, and then we're talking about all-time highs. Here it is on the hourly time frame chart. I think it's fairly straightforward. If you're up here on early on in the week, great. It's bullish and healthy consolidation, looking for that breakout we just described. If we're underneath, I would be open-minded to highs, lower highs, looking for the flush and the gap fill reversal off of 400. Next up is Google, new all-time high. So this is going to be incredibly easy to talk about. Let the structure build out. Let something happen up here. If we drift into the gap, lower highs are interesting. Gap closes, of course, ultimately what you're aiming for. Does it have to close all the way? The answer is absolutely not. It never has to close the gap all the way. If you do spot a random reversal in here, there's nothing wrong with taking it, but of course the issue always becomes a move back into that range low. All right, so 169.65 is a key inflection point from that point of view. If there's a lower high set there, then the gap is likely to close all the way. If you battle back into the earnings gap range, then I would argue consolidation and probably blue sky territories after that. There's really not enough structure built out yet where I could say that you have a definitive edge early on in the week. Notice we've closed smack in the midpoint of the overall range based on Friday's activity. Here is Amazon, certainly a sympathy mover to both Meta and Google and Microsoft. I mean, just all over the place here. I do like the failure from the sellers to really materialize on the lower high underneath this inflection point at 174. Consolidation here strikes me as healthy. What's the issue out of this one? Earnings Tuesday after the close. So probably not worth trading on Monday. Implied volatility is going to be through the roof. Tuesday, obviously, is the release, and we'll see if there's something that's constructive into the end of this week. So you guys know me. I'm really not very curious about earnings trades. I'm not interested in putting up a lot of risk in a high implied volatility environment. So this is really, I know a lot of people get fired up around earnings, but I'm actually like, please, could we get this out of the way so we can go back to normal conditions? The one saving grace is that NVIDIA, the one stock to rule them all, always kicks the can way down the road. We're not expecting anything until the end of May. So as of right now, I have to be constructive on NVIDIA with the strong close on Friday, up and over the bottom of the overall balance at 841.50, right? If this is the overall balance, this is a move below. Rejection lower high actually stepped in beautifully on Wednesday. It was a great trade, but as we can see, it was nothing more than a trade. We're not continuing in the downward direction. And as of right now, there's really two outcomes, either continuation to the top of the range overall, which I would use 922, or pullbacks that offer higher lows over 841.50 that hold the daily 50 SMA. Beautiful opportunities for a tight risk reward long, right? Basically, you're using this as an inverted head and shoulders. And for the folks who are familiar with the penthouse, there is your inverted man ray, right? There's the double bottom stacked in there. So 841.50 as a key inflection point. Here it is on the hourly time frame. Consolidation here is bullish, breaks higher lows, moving in the upward direction. You could look for the pullback if you wanted to try to stab short from here, 860 into 841.50, be my guest, but it's sort of counter to the thesis that we've just set forth, right? The idea would rather be to say, where's the actual, hourly double bottom here? Where's the inverted head and shoulders? Where's the hammer candle around 841.50, right? So that is my primary watch. If we're underneath that, certainly worth reconsidering. And one of the things that could do that is a sympathy move to AMD earnings, which are Tuesday after the close. Speaking of, here we go. AMD on a daily time frame chart, much weaker than NVIDIA, obviously. Earnings are an issue, so I would not be trading this early on in the week until earnings pass, and we have the resolution from the implied volatility out of the options chain. The big threat here is still the possible lower high underneath the neckline of the overall head and shoulders. So even if there's good news, even if there's a rally on Monday, today. Lower high threats exist underneath 164.60. If we clear that, I would change my tone, but as of right now, we're going to wait for earnings to pass on that. Here is the metaverse. Again, very straightforward. You're letting the structure build out. You can see the inside day on Friday. If we take it on, well, firstly, let's understand that this is a gap, and this, of course, is a gap as well. So there's a double gap in this zone right there. If we take it down to the hourly time frame chart, here is your bar-to-bar high or low. Technically, it's a bullish 3-bar play that's been setting up. If we can clear that high, looking for a move in the upward direction, and there's just thin structure to retrace. So you can read the numbers off right here, 443.25, 453.50, then the gap closes at 484.60. If we're just consolidating inside of the range, not really interested in any large plays out of Meta. Next up is Tesla. What's going on with Mr. Musk getting back in gear here in the upward direction? Friday, inverted hammer. Looks over the high of the Thursday session. I would not be surprised for a retest of 161.25, the bottom of the overall balance range, right? This is the balance. This is your breakdown. I would call that a successful breakdown. We more than doubled the balance range in the downward direction. So now, if it's going to be constructive for longs, you want to see the bottom end of the original balance hold up as support. So once again, 161.25. If we can spot buyers here looking for the swing back in the upward direction, ultimately the target would be the top end of the range at 182.25. Let's take it one step at a time, but based on Friday's activity, I would be thinking about the pullback first earlier on in the week. Here it is on the hourly time frame chart. You're looking for this to act as, some sort of very nuanced micro head and shoulders breakdown here, looking for buyers to respond at this level as we've just described. If it really moves for a stronger sell side setup, look for the break, then the gap close from earnings is your major watch, right? The lower high underneath the zone becomes fairly interesting. Lastly, we've got Netflix, and then we're going to transition directly into our singular trade idea. It's fairly sparse out there right now. Netflix is... Someone turned the volatility switch on over here, just down, up, down, up, down, up, down, up, down, up, down, up, and it's still doing that post earnings. It's just one day down, one day up, one day down, one day up. So be my guest if you want to trade this thing. It's been incredibly frustrating to watch and try to chart. I mean, it is respecting some of the key levels, so I suppose that's nice, but in terms of percent probabilities of it respecting, those levels and offering some sort of actionable setup, really far and few between recently out of Netflix. So if you like trading it, be my guest. Here are the levels I would really encourage you to pay attention to. We've got 605.25, 579, 554.30, 536.50, and then 499 is the previous earnings cycle gap close. So there's that if you'd like, but here we go. The singular trade idea is on WDAY Workday. What do we see out of Workday? A beautiful H pattern in the works, bearish 3-bar play in force, although we did not have the momentum side of things on the Thursday bar. Certainly more of an indecisive doji. Let's actually go back to the daily so I can describe that a little bit further. Indecisive doji, but lower high in the overall context of a downtrend that's developing, sitting on an equal low as of Friday's close. These lows are all very precise, marking the improper end of the auction. I would not be surprised in the slightest for a breakdown and a test underneath 250.75, for this to sustain itself, looking for the lower high, and the gap closes way down below at 237.25. There is no issue with earnings. They're much further down the line towards the end of May, very similar to, of course, NVIDIA. And the larger time frame pattern that's in force, here it is. Put this thing in a textbook. There is your head and shoulders. There is your neckline. That's exactly the lower high that we were just tracking. So this is in force as long as we're below 260 out of Workday. If we pop 260 and higher low above, I might be willing to change my tone, but it's probably just a non-trade, and we take it off, sort of the watch here. So primarily focused on the downside. And with that, we're going to wrap up this week's episode of the Weekly Watch List. Remember, it's going to be a busy week. We have earnings across the board. AMD is an honorable mention. Of course, Amazon, Apple as well. You're going to get Jerome Powell on Wednesday for the FOMC and his press conference, and then we're going to follow it up on Friday with the labor market report, unemployment, the monthly situation, the NFP, as well as hourly earnings. So do not expect volatility to go anywhere this week. It's going to be another wild one, and we are technically in no man's land out of the S&Ps. With that said, if you learned something new or enjoyed today's video, check out the thumbs up button down below, but more importantly, the subscribe button down below once again for 100K by May. We will be live up in the Penthouse Studios on Monday at 8:15 for our pre-market prep. Hope to see you there. I wish you all a green trading week, and we'll see you in the next one.